This year, 2-year fixed-rate mortgages rose above 6%, the highest level since Liz Truss's disastrous mini budget last September. It threatens to add an extra £2,500 a year to the average mortgage. By next year, total mortgage payments could be an extra £14 billion compared to 2021. Whilst last September's surge in rates was closely linked to an extravagant budget of tax cuts, the current rise in mortgage rates is looking more difficult to reverse, which will have profound impacts for house prices and the economy. How did we go from ultra-low interest rates for 12 years to the biggest mortgage crunch since the early 1990s? And does the current mortgage crisis prove that Liz Truss was right after all? In 2009, average house prices were around £149,000, with first-time buyers paying around 32% of their income on a mortgage. Until 2022, despite rising house prices, mortgage payments as a share of income remained constant, around 30%. However, the recent rise in interest rates risks causing mortgage payments to soar to levels not seen since 2008 and 1991. Homeowners have been rational in taking out ever bigger mortgages despite very high house prices, because the cost of borrowing was so cheap. Why pay £1,500 a month rent, which is effectively dead money, when you can take out a mortgage at a fixed rate of 2%? Not only that, but the UK's obsession with the housing market meant that the government were helping people to get even bigger mortgages through Help to Buy. And also, very importantly, parents who had seen big increases in their own value of their house were helping their children with deposits to be able to buy more and more expensive houses. And the result has been a surge in average deposits. An estimated £54 billion of parental wealth entered the housing market between 2011 and 2021, all helping to push up long-term house price to earning ratios. And on top of all this, the Bank of England's own £800 billion of quantitative easing has helped to further inflate asset prices. If we go back to 2009, the global credit crunch hit the banking sector with great force. The government was forced to bail out banks like Northern Rock and Lloyds. The credit crunch led to a deep recession, a drop in bank lending, and a 20% fall in house prices. When people say house prices can never fall, remember that they can, and very quickly. In response to the dire conditions, the Bank of England cut interest rates to record low levels of 0.5% in a bid to stimulate economic activity. However, the depth of the credit crunch, combined with government austerity, meant that even interest rates of 0.5% failed to return the economy to normal economic growth. The Bank of England was so worried, they embarked on a policy of quantitative easing. Between 2009 and 2019, the Bank of England injected £425 billion, about 22% of GDP, into the UK economy. The aim of quantitative easing is twofold: increase the money supply to stimulate demand, and increase the price of assets in order to reduce bond yields. But by increasing bank reserves and reducing interest rates, a side effect of quantitative easing is that it increases the attractiveness of investing in the stock market and assets like the housing market. Between 2009 and 2022, UK house prices soared by 83%, remarkable given that real wages almost stagnated in this period and inflation was very low. In the past decade, the UK has been better at growing wealth rather than income. And from the perspective of buyers, the cost of housing is not really the house price itself, but rather the monthly mortgage rate. And after 12 years of ultra-low interest rates, there was understandably a feeling that this was the new normal. Now, does all this extra quantitative easing money going to banks cause inflation? For 12 years from 2009 to 2021, inflation was broadly close to the government's target of 2%. In 2012, the UK had a surge in inflation to 5%, which in those days seemed a lot. And there was pressure for the Bank of England to raise interest rates, reverse quantitative easing, and bring inflation under control. But the Bank of England correctly predicted the inflation was just temporary, from high taxes and a devaluation in the pound. They kept interest rates low, and inflation soon fell back. And this will be important for understanding why the bank got it wrong later in 2021. During the COVID crisis of 2020, GDP nosedived, and the Bank of England bought an additional £450 billion worth of UK government bonds, bringing the total of quantitative easing to 875 billion, or 40% of current GDP. Again, interest rates were pushed close to zero, and we had another boom in house prices, even as real wages stagnated. But then in late 2021, the global economy had its first inflationary shock for decades. COVID supply shocks, followed by rising oil and gas prices, led to a sharp rise in inflation. Now initially, the Bank of England calculated this was like 2008 and 2012, temporary inflation which would fall of its own accord. However, this didn't happen. The inflation shock was much greater than 2012. And the UK was particularly badly affected, with rising oil and gas prices feeding through into higher food prices and Brexit shocks to supply chains making it even worse. In late 2021, the Bank of England belatedly started to raise interest rates from their historical lows. But then in September 22, with a backdrop of rising interest rates, high inflation and weak economic growth, Truss and Quadting made a bold bid to boost economic growth with large tax cuts to business and high earners. But markets were shocked for three reasons. Their plan would cause the government deficit to soar nearly double to £190 billion. Secondly, the stimulus would cause even more inflation. And thirdly, even rich bankers knew it was a political disaster to cut taxes for the rich during a cost of living crisis. Bond yields soared because the budget promoted more inflation, rising interest rates, and markets started to have some concerns about government debt, which hadn't surfaced for many years. So when Sunak reversed this disastrous budget, interest rates fell close back to their pre-September crisis level. A degree of calm returned. And at the start of the year, the Bank of England were forecasting inflation would fall back to target of 2% by early 2024. With this kind of forecast, it looked like interest rates may soon peak and be able to fall potentially next year, and the mortgage crisis may not be so bad. But the problem is that inflation has yet again turned out to be higher than expected. Whilst US inflation has fallen to 4%, the UK has one of the highest inflation rates in the developed world. Despite falling oil prices, UK inflation has persistently exceeded the forecasts of economists. Inflation is no longer just due to higher energy and import prices. Inflation has become more embedded. Services inflation is a good measure of domestic core inflation. Belatedly nominal wages are rising in a bid by workers to try to keep up with inflation, mostly failing but still causing inflationary pressure from rising nominal wages. This raft of bad news on inflation was a trigger for the current rise in mortgage rates. The difference between mortgage rates and the Bank of England base rate has shot up, which means current mortgage deals are much more profitable for banks. And in the short term, you could say this is profiteering. But banks would probably argue they are raising interest rates because they expect significantly higher base rates in the future. The Resolution Foundation say base interest rates may have to rise to 6%, and Mark Carney warned they may remain elevated for a considerable time. But also, perhaps there are other things going on. In the past few weeks, there's been a sea change in attitude to the housing market. There's an increased awareness that house prices are overvalued, and the interest rate shock is a potential tipping point for bigger falls in house prices. And this shift in attitudes is important. Buyers know they can get a bigger discount on the asking price, and even estate agents are advising clients to be more realistic on price. And given this very realistic prospect of falling house prices, banks will be more circumspect in lending to homeowners who could struggle with high mortgage costs and potentially negative equity. And what about the role of quantitative easing in all of this? Well, last November 2022, the Bank of England began the process of reversing quantitative easing, sometimes known as quantitative tightening. So they sell off the government bonds they have bought. And this has the opposite effect to quantitative easing. Selling bonds reduces asset prices and pushes up interest rates. In November, it sold 0.7 billion out of 838 billion, so a drop in the ocean of its current reserves. And this is a great unknown of quantitative easing. What happened when you reverse it? This is perhaps an additional concern for banks. One feature of quantitative easing is that they increase bank reserves we currently have aimed to give greater financial stability. But the large reserves of banks are perhaps less abundant than they may seem, because they adjusted to a new normal of low interest rates and high reserves by taking more risks. Because more risk, after all, was kind of a point of quantitative easing. Now, it's perhaps not as bad as the subprime mortgage days of pre-2008, but bad loans and defaults have been increasing. For example, Silicon Valley Bank in the US had a great business model if interest rates stayed low, but the sudden rise in interest rates caused it to become unprofitable and quickly go out of business. The truth is, it's actually hard to know the full effect of quantitative easing on the economy, because with the exception of Japan, this scale of money creation has not happened before. A final complication of quantitative easing is that when interest rates were very low, central banks were effectively making profit on government debt. But now interest rates have risen, they are paying more interest to commercial banks, so government borrowing has become more expensive. Now, an interesting question: does the current surge in mortgage rates prove that Liz Truss was right after all? Well, in a word, I would say no. Basically, if we had Truss quartang economics on top of the current inflation statistics, there would be even more upward pressure on inflation, more upward pressure on interest rates, and probably the selling of sterling too. The crisis would just be more severe. You can't solve the current mortgage and housing crisis by large unfunded tax cuts. On a more positive note, it is worth pointing out that the mortgage market is particularly volatile at the moment. If we see better than expected inflation statistics later in the year, the outlook could change for the better. Inflation is forecast to fall later in the year with falling food inflation and lower petrol prices. Also, due to time lags, the higher interest rates we've already seen will increasingly work in slowing the economy down and therefore slowing inflation. The Bank of England's own stress tests from 2022, which are probably outdated now, but they suggest that interest rates of 6% would be unsustainable for the economy. So there is some hope that the current fear of permanently rising interest rates may be overplayed. I'm definitely hoping so. I've got a tracker mortgage. But even if interest rates were to peak at 5 or 5.5%, that's still going to be very costly for many homeowners. As they remortgage in the coming months, it's still going to be a very large jump. And the number of mortgage approvals has fallen really quite dramatically. If you found this video useful, I went into more detail on how the UK is facing recession from this interest rate shock and the other factors pulling it down.